John Hansen here, Michigan Mutual Mortgage. Just want to go over a little bit of information on what I see coming down the pipe here for interest rates over the next couple of months. It's going to be vitally important that you reach out to your clients. Make sure you get in front of this. Make sure you let them know what's coming and what might transpire so that you can look like the hero. Listen all the way to the end. I'm going to go through some vital information for you, and let me know if you have any questions. All right, as we get started, I want to talk about inflation and how it affects interest rates. I'm just going to do a broad overview of it because that's really all you need to understand what's coming down the pipe here. But a later video I'll probably put out will go into a little bit more detail so you can understand the relationship between inflation and interest rates. But for the purpose of this, as inflation increases, so do interest rates. And the reason being is that most things are a fixed rates investment. So a fixed rate investment might bring in, say, $1,000 a month. With that $1,000 a month, you might be able to buy X, Y, and Z. If things start to increase in cost, the $1,000 might only buy you X and Y. In order to be able to buy X, Y, and Z, you might need to charge more interest so that you can increase how much income is brought in. So the next time you do that investment, you're going to be charging more interest so that you can still be able to buy X, Y, and Z. And that's really what's important with interest rates and inflation. The Consumer Price Index, that tracks how much inflation is changing from month to month. And they look at an overall 12-month picture to kind of see where things are heading and how inflation has been doing. So they add up the amount of change over every single month to come up with a yearly number. And one thing we can see here is that in, say, June and July, we had a pretty big increase from where we were negative on the beginning of the pandemic. And you can kind of see what happens with the stimulus and people starting to spend money. We also got another stimulus here at the end of the year, and you can see January and February, we started to see some increases in inflation again. And those were actually bigger numbers than what was anticipated, which scared the market a little bit and drove interest rates up. So if you take this, if you add up every single of these months, including March and April, which were negative, we're on a pace for about 1.7% inflation. Now, the Fed wants to see inflation be under 2%. If it starts to go above 2%, that's when they start thinking inflation is getting too hot. It worries markets. Interest rates start to increase. So going forward, what we can see, if we add in March and say it's going to be the same as February, and I think this might be conservative as we just had the stimulus, they're starting to hit people's accounts on the 17th. I think you might see more than 0.4% increase in inflation, but say for a conservative estimate, we'll take a look at March being 0.4. Now we're getting rid of March 2020, which was a negative number, and we add all these numbers up. So we replace a negative number with a positive number. Now all of a sudden we're at 2.4% inflation. And this March number is going to come out in the beginning of April. The bigger thing that I see coming out is the beginning of May when April's number comes out. Again, let's say we're conservative from the stimulus and it's only 0.4. Now we're replacing not just March of minus 0.3, but April of minus 0.7. And we're replacing with two positive numbers. So when you add this up, you're going to see inflation at 3.5%. Now, I do think it's going to be temporary, and it's going to start to cool towards the end of the second quarter, beginning of third. And we'll start to see inflation numbers come back down. But this number right here, this 3.5%, is really going to scare the markets. And when the markets get scared like that, you're going to see interest rates rise. So you want to make sure that you get out in front of this with your clients. If you can kind of see right here, we saw interest rates rise significantly. This number going down is the mortgage bonds. This is a bad number for interest rates because they're related inversely. So right here is where we started to see a little bit higher inflation numbers than what was anticipated, and you can see how bad the markets went down, and that's not good. And I think we can see this times 2 or 3 because this is that 3.5% number is really going to scare the markets. So you want to make sure that you get in front of this with your clients. If you have clients that are out looking to buy, if interest rates goes up, they're not going to be able to afford as much, and this is a really tight market in terms of inventory, and that's going to prevent them from getting some of the home that they want. some clients also might be scared when interest rates go up, thinking, hey, they're going to come back down shortly, so they might not move off the market. And lastly, those clients that are on the fence on selling, that might be waiting until summer, you're going to want to reach out and get in front of these guys too, because when there's less clients that can afford their home, or there might be less clients looking, it's going to be a bad thing for people who are looking to sell in this market. And it might help them get off the fence if you're able to educate them on what is going to happen and what this means. So if you have any questions, feel free to give me a call. It's area code 517-712-0271. Otherwise, I hope everybody's doing well, and we'll talk to you soon.